Hi everyone, this is Craig, the Options Linebacker, and this is the weekend report for Sunday, January 10th. Instead of doing a chart-based overview about where the market's going, it's going up these days, I thought I'd shake things up a little bit and talk about our trading strategies that we use for the Options Linebacker daily newsletter. Now, I hear people talk about the fact that this is a difficult market to trade, and I don't disagree, but all you have to do is match the trading strategies to what the market is doing, and you can have a good comprehensive approach to generating income from this market. Let's see how we do it. First of all, if this pyramid represents my trading equity in my accounts, then first of all what I'm going to do is put in a foundation for non-directional trades and income through using iron condors. Now on top of that, I'm going to add directional income if the market type supports it, and we'll talk about this in a second, through selling puts and covered calls. Now notice that this is a smaller portion of my trading account. I'm using less equity here for these types of trades. And lastly, if the market supports it, we will look for swing trades. And again, notice how this is using the smallest portion of my account for these directional swing trades, which are generally higher risk but also higher reward. So by doing so, we have a comprehensive approach to the market. We have non-directional trades, we have slightly directional trades, and we have heavily directional trades to be able to take care of all different types of market action. Let's see how these would play out. The iron condor can be traded in almost every type of market. The initial bias that we put on is slightly delta negative, but we can adjust that trade through rollouts, adjustments through opposite credit spreads, or also synthetic hedge positions. It's a very dynamic and flexible trade. Selling puts or covered calls, the first requirement is we have to have an uptrend, which is generally the 50-day moving average crossing above the 200-day moving average. The goal is to never be put to stock and sell puts every month. It's just easier that way. But if I am put to stock, I'm okay with it at that price, at which point I'll just sell calls against this stock every month until I'm called out, and then we'll just start the cycle again by selling puts. And lastly, we have our swing trades. We have 4 different strategies of swing trades that we're playing, all very mechanical, but the underlying market must match the strategy or we sit on our hands kind of like a sniper, if you will. So we're only entering these when we have a defined edge and we're trying to set up the best risk reward and the highest probability trades. Most of the time with these strategies we are in cash. So let's take a quick look and see how we're applying these strategies this month through the Options Linebacker newsletter. First of all, at the bottom of the period, we have February positions in play for what I call the high probability iron condor. These positions that were set up as far out of the money as possible while still getting a decent credit are generally showing about a 90% probability of success as soon as we enter the trade, right around that area. And so what we're looking to do is if the entire iron condor expires out of the money, we'll look to earn about a 15% return on risk for this trade. Not a bad return for the month, but we do actively defend the trade. Now, we use technical analysis for these types of trades, and the reasoning behind this specific trade is that we have very heavy resistance levels at Russell 650 as well as about Russell 656. We think will be very difficult to penetrate and come after this specific trade up here, this bear call spread. As well as we have lots of different support levels now on the Russell, which will prevent the price from just diving down and attacking this put spread down here. So we have a nice wide range on this, and this is a very easy to manage trade that doesn't require a whole lot of attention, however does demand respect. It's definitely not a set it and forget it trade, because when you have to act on defense, you have to act. Now we play more than one type of iron condor. The other type of iron condor that we have in play for February is what I call a delta neutral trade. You'll notice here on the P&L graph that what we're risking on this trade down here is the same height as what we're trying to make. So this is a 1-to-1 risk reward trade. However, you'll notice that the wings on this iron condor are not very wide, so we have to be a little bit more active as far as our defense. Now, our defense in this example is not through technical analysis. We don't use any technical analysis on these type of trades, perhaps a little bit when we do enter. But once we're in the trade, all we look at is our Greeks to understand what decisions to make based on that. So in some ways, this is a very mechanical trade because I'm just letting the numbers dictate what my actions are. I've pre-programmed my actions in depending on what these numbers do. Now for the next trade I'm going to highlight, this is the selling puts trade. So we don't have any current stock right now. We have just sold puts on the IWM at the 58 strike, and we did that a few days ago, so the price has run away from that strike. So we could probably buy it back for a small profit right now, but the idea is to run these things into the ground, or at least buy them back for a very, very small debit. So as long as the price stays above this 58 level on the IWM, by February expiration, which is this green line here, I get to keep this credit and just move on and sell puts the next month. In fact, what we do is we play more than 1 month at a time, so by the end of January I'll be looking to place March short puts as well too. And lastly, what I'll do is I'll highlight the one swing trade that we're currently in. Now, what's all this line with all these squiggles on it? Well, first of all, the pink line here is the Bollinger Bands, the pink line on both sides, and the orange lines here are the Keltner channels. And both indicate volatility. The Keltners are based on average trading range. So what happens is when you have a very quiet market and the Bollinger Bands actually go inside the Keltner channels, in this case, what we have is what's called a squeeze. It's a very quiet market doing nothing, and then what that portends is that you're about to have a big move off of there, because contraction always indicates that expansion is just around the corner. Now what we've done in TradeStation here is just to program this in as an indicator to tell us when that squeeze is happening and when the releases come, and then we just trade in that direction of the breakout on a pullback to the 8 EMA on here. So you can see that this is where we entered, and here's where the price currently is, and on any pop above that Bollinger Band we're going to take profits on half the position. The stop ends up being at the 21 EMA on a daily close below that. In this manner we can trail this stop up behind it and have a nice loose stop to allow this trade plenty of room to breathe and to be able to expand. So there you have it. We have iron condors, a couple of different flavors of those. We have selling puts. We also have one particular swing trade strategy that fired away, and all of these are based on indices too. We don't have to worry about earnings or anything like that. Occasionally we'll have to duck and deflect at big economic reports like the FOMC meeting, or perhaps jobs like what we saw on Friday. But none of the homework associated with individual stocks as far as knowing what the earnings are or the earnings dates of any particular sister stocks that are in the same sector. So these are just very simple strategies that we bang away on every month and earn consistent income on. Questions, email us or check us out for a few days for free and see what we're all about. Take care and have a great weekend, folks.